So now let's talk really quick about defining value. There's kind of different parties involved in defining value, depending on who you are and what your perspective is. But what we always want to be careful of when we're making offers, especially if you're financing the property, is where's the Venn diagram? Where's the overlap, like is on the screen right now? Because the appraiser is kind of the middle ground between the buyer and the seller. And we want to be aware of what we think the house will likely be able to appraise for. Before we dig further into that, let's talk a little bit about the definition of value. Again, from dictionary.com, it's the relative worth or merit or importance, estimated or assigned. It's a valuation. So the relative worth or importance depends on who's assigning the value. The value to you, the value to me, and the value to somebody else may all be different things, right? Some people may not be willing to pay hundreds of dollars for Air Jordans, and some people may think that's a great deal. Some people may not be willing to spend a lot of money on a classic car. Some people, like me, are willing to spend too much money on a classic car. So the value is a little bit subjective in what that is. You want to be mindful. You can look at other things, but the value of each thing depends on who's looking at it and where they think. What we want to find is that sweet spot of the overlap. So fair market value is another term that you want to be aware of around this, because the fair market value can be misleading. This is different than an automated value. We'll chat about that in a second. But the fair market value, this is what an appraiser looks at heavily. And if you're financing, this can really impact the structure of your deal. The fair market value is considered as the determined price that a property is going to sell for in an open market per Rocket Mortgage with no external pressure and non-arm's length. That is like the properties exposed to the open market, like most of the properties that you see when you're looking around for houses, and there's no pressure. That means there's no outside pressure or distress forcing the clients to sell. It's not a distress sale. It's not like a foreclosure, tax auction kind of situation where there's an artificial pressure coming in. And it's a non-arm's length transaction. Oftentimes, parents will sell a house to their children at a big discount. Other things like that. Non-arm's length means they're kind of far enough away. They're not close enough for you to wrap your arms around them and give them a hug, is how I interpret it. I don't think that's the dictionary definition, but that's how it works in my mind's eye. They've got to be basically a stranger, fair market, no pressure situation, whatever it trades at, that's what the value is. That's the appraiser's job, is to determine what do they think, what do they believe the fair market value to be based on industry data and what has happened in the transaction, and then supply that to the bank. So let's talk about the three different values that come up in a deal. I mentioned it briefly. The seller has an idea of value, and most sellers are really proud of their house and they think it's worth more than what it is. That's the case most of the time, although in a really strong seller's market, not always the case. That's where you see things selling for over list price. With one exception, some people will use a strategy where they'll underprice initially to try to create multiple offers. Doesn't happen a lot right now. It was happening a lot a few years ago. Then the buyer has what they think is the value. The buyer's value can be much higher or lower. And if all the buyers think the value is lower than what it's listed at, then the property is going to sit there. If all the buyers think that the value is higher, it will get a multiple offer situation. And then the third party for value is the appraiser. Now, the appraisers are hired by the banks nowadays. We talked about that a little bit in the team building. We don't get as involved with the appraisal process. So we could say 15, 20 years ago in kind of creating appraised values, if you would. Now it is a much more independent process, and they have a set criteria that they go through in a scientific method. There's a little art to it, but it's really very scientific in how the appraised value is reached. They are going to set a value on the property. I would say the truest value is what a buyer and seller agree at, and appraisers can cause problems in deals when, especially in fast, hot, competitive markets where they can't keep up with what's going on, because the appraisers are always looking backwards at old data. Appraisers and sellers are always looking backwards at old data, Buyers are always looking forward at what's likely to happen, what's going on in the future. And so even that can impact how everybody's eyes see the value in a deal. And that brings us to the value of a house is not a thing that I suggest most people get too attached to. How much are you willing to spend for this opportunity? What is this opportunity worth to you? And stick to that number, because the value is a snapshot in time. It's going to change. It's going to go up. It's going to go down, just like the stock market. It's going to move around. You'll see one house close in a neighborhood, and a week later another house closes and that price goes up or down, and things are always sliding around. So we don't encourage people to get too caught up in the value over time. It does depend a little bit what your goals are, what you want to do with things. If you're trying to be a flipper and really time the market, then it is a little more important. But if you're a homeowner looking to buy a home to live in for 5 to 10 years, you can be a little more detached from value because you have more time for the market to work its magic. For example, if you bought in the peak of 08, 07, right before the crash, right as it was getting to its highest high, did you pay too much for the house? A lot of people then said they did pay too much for the house and they felt really bad about it. They felt ashamed, embarrassed, guilty, whatever it is. A lot of people in the business felt bad that their clients had spent so much, but that's what the market was saying based on market conditions at that time. That's part of why we encourage you, like, can you afford it? Does it work? So you can make a decision that you're confident with and not be trying to keep up with the Joneses as much as possible. If you needed to sell in 09 and you bought at the peak of 08, you probably paid too much because the market crashed on you. That was a problem. Even then, a case could be made that you didn't pay too much. You paid market value and the market got away from you. But if you held that house till today and bought in the highs of 08, it still looks like an amazing deal that has performed really well for you over time. Now, you could really try to beat yourself up and be like, well, I should have waited till 09 or 10. The fact of the matter is you are still winning in a very big way. So defining the value and paying too much in the moment is a tricky thing to do. It depends on what your plans are, what your goals are with the property, and how much the property means to you and what it will do to your life and the memories that you can create in the property. That just goes to show that value is in many ways like beauty. It's in the eye of the beholder. What something's worth to me may be different than what it's worth to you, right? I see a lot of investor deals, especially off-market stuff, where they have different values and there's opportunities available to investors to buy before the property gets on the MLS.